IVM.
On this episode of Paisa Vaisa, I speak with Gaurav Rastogi, CEO and founder at Kuvera. We're going to talk about the behavioral aspects of investing. You know that stuff when markets go up and you react in a certain way, markets go down, you react in a certain way. We're going to talk about all of that and how you can make better decisions keeping all of that in mind. So stay tuned for that.
Hello everyone, welcome to Tech Careers in the new podcast series presented by Accenture. I'm your host, Shiladitya Mukhopadhyay. In this podcast series, we'll get you the latest and greatest in the world of technology that's shaping the future of business as we know it. We're talking intelligent platforms, cloud, AI, blockchain, extended reality, and a whole lot more. Every fortnight on Wednesdays, we'll have for you a hot topic with expert speakers from Accenture talking about top trends in the space, how these are changing the world and creating growth across industries. And importantly, we'll tell you how you can learn more, build your skills and expertise to grow and stay relevant in your career. Episodes out on the IVM Podcast app or wherever you get your podcast from.
Folks, welcome to Paisa Vaisa. I'm your host Anupam Gupta, B50 on Twitter, and this is going to be the behavioral aspect of investing special. My guest is Gaurav Rastogi, CEO and founder at Kuvera, a mutual fund platform that I've always wanted to have on the show. Gaurav has come to us all the way from Singapore, braving the Mumbai rains for us. Kuvera is based in Bangalore and in Bombay. And in this episode, we are going to be talking about a lot of the behavioral aspects that goes into your investment decision making, especially around mutual funds. Gaurav, welcome to Paisa Vaisa. Thank you so much for doing this for us. Thank you for coming all the way from Singapore, Bangalore, or you're a global citizen, as I've been able to make out. So thank you for doing this for us. Let's first start with a brief introduction to yourself. Just, maybe talk to us about what Kuvera is about. I know that you guys were the first to do whatever you are doing. So let's start with a small introduction to yourself, to Kuvera, and we'll build on to that.
Sure, yeah. Thanks, Anupam, for having me here. It's great to be on the show. Good to be able to talk about behavioral aspects of investing. About Kuvera, as you mentioned, we are the first direct platform which went free. This was in October 2017. So we kind of started this trend of platforms moving from regular plans to direct plans and then also offering it as a free service. We fundamentally believe that a free investing platform, especially in mutual funds in India, makes a lot of sense, given the infrastructure we have to do so. We think of ourselves as investor-first platform. We build a lot of features. We build a lot of intelligence that any investor should need to be able to invest prudently. Our thinking is based fundamentally on both, some parts of behavioral finance and some parts of efficient market theory to ensure that people are not chasing returns. People are not spending too much to invest. People are not always confused, right? Simple example that we always give and that I also know is true for a lot of people, and this is a question that every listener should ask themselves. A lot of people I know, what they'll do is they'll have 20% of their portfolio invested in mutual funds and equities, right? And then they will fret over it to make 2% more. And 80% is sitting in cash, earning no returns, right? Okay. So we call it the cash trap. So the first thing if an individual comes to us and says, hey, you know what, this fund has given this much returns in the last 3 years, the first question you ask is, how much of your wealth is in cash? Because that cash drag is what is actually going to make sure that you're not going to retire wealthy. Yeah. Making that 2% more in that. So people always go for marginal gains. It's a contextual thing. So our thought process is to think more holistically about people's portfolios. So we've started with mutual funds, but we are going to go into a lot more different asset classes to be able to advise on that holistic wealth portfolio on how people should allocate for their different goals, for different financial goals, life goals, or whatever they want to do with the money. So that's what we stand for.
I have to ask, Kuvera. What does it mean? What is it? Is it Greek? Is it? I don't know.
It's Pali. So Kuber, right? Oh. Kuber is the guardian god of wealth.
Wealth, of course. Yeah.
So the Pali name for Kuber was Kuvera. Oh. And we thought Kuvera had a bit more of a global name, and it also, we didn't want to call it Kuber because that would have been very direct.
Yeah.
So So that's why Kuvera came about, and it also had the word era in it. So in a way, we were thinking about this as a new era in personal finance management, mostly driven by the headwinds that SEBI had created by instituting direct plans. So that's how the name came about, and quite liked the sound of the name. So we stuck with it. We didn't want to have the name to include words like wealth or money or,
Yeah.
because then it kind of, then it's not a brand. Then it's just like, very literal.
Sure. Okay, so Gaurav, let's get into this.
Sure.
The data that I have been seeing, reading, tracking, roughly, I believe that we have, I don't know, about 3 crore folios or 3 crore number of SIPs, and the average ticket size of this is about 3,000 or 4,000. So roughly the mutual fund inflows via SIPs, as we know it, is in the region of 8.5 to about 9,000 crores, and it has stayed steady, I think, over the last 2-3 months. We are right now in July 2019. I remember when I started this podcast somewhere in the middle of 2017. My
wow.
God, those days were like, you just had to be in SIPs. The concept was still new. Okay, so people were signing on. I think that momentum continued throughout 2018. I believe last 2-3 months haven't been great. Okay, now having been great depends again on how you look at the picture, whether it's on registration of new SIPs. I'm sure you'll help me with that data, whatever is the update thing. So my first question, I want to start off this thing with first understanding what's happened in SIPs, okay, and then trying to find out what's happening behaviorally. So can you help us with that?
Sure. So I think the data you have is of course correct. We are seeing a bit of a flattening out of the SIP book, as they call it, on a month-on-month basis. And we think there are a couple of things driving it. So what we see on our platform, and we mostly have very detailed data for our platform, and I think it kind of translates very well to the entire ecosystem, is that people are not stopping existing SIPs. So that's a good thing behaviorally. People are getting the fact that you should be investing up markets, down markets. I think fundamentally people do understand what rupee cost averaging means. Unlike a lot of, when you go on Twitter or when you go on Facebook, right, they make it sound like that all investors, they do nothing. That's not true, to be honest. People are smart, people get things, everyone needs to be, when we were kids, our teachers taught us things, right? And then eventually we know them, we apply them, right? People are very similar. So investors that we see on our platform, they're not stopping existing SIPs, but we see that new SIPs are not starting at the same frequency. One can argue that we should not be worried about where the market is. If you have the money to start a new SIP, you should start a new SIP, or you should add to an existing SIP. And that part of the behavioral gap is still there. So the reason behind it, actually pretty simple. Last year, the markets haven't done much. It's been quite volatile. Headline news has been mostly scary. And even though we write about it all the time, we call it the entire financial press or financial journalism's noise, that you mostly ignore it, right? I mean, they are only magnifying whatever the latest story is, but in the long run you'll forget all about it, right? Like 2016 July, if I ask you what was the top story on CNBC TV 18, no one will know.
I know in November it was demonetization. But yeah, July, you're right.
The point being that at that point, which is like kind of like, that what people call is that the recency effect. At that point, it's top of your mind. That's all you're thinking about. In the long run, you forget very easily, right? So that gap is still there. People are not starting SIPs at the same frequency as they used to. Good thing is that they're not stopping existing SIPs. So overall, I would say it's a good plus. It's a good plus from where we were probably be in 2007, 2008. It can always improve, but things can always improve. So not too worried about that.
Okay, anything generic here between large caps and mid small cap SIPs? I mean,
So we see some, on our platform actually, we do see some opportunistic buying in the mid and small cap space. But in terms of SIPs, not much of a difference. People who have the SIPs running in small caps are continuing. People who have SIPs running in large caps are continuing. We don't see any statistical difference in, they're stopping more SIPs than the other guys. But yeah, after the recent fall in small and mid caps, people do seem to be getting into it a bit more.
Okay.
Which again is a good thing. Honestly, we did, when the first the mid cap small cap crisis hit first, this was like second half of last year.
2018, yes.
Right, second, and it was down 10-15%, and half of the people were saying it's start of a massive bull rally, half of the people were saying it's going to crash more. That ratio, by the way, still hasn't changed. That tells you how much people in the market know.
Okay.
50% will always say this is start of a massive bull rally, 50% will say no, it's going to crash 50% more. And one of them will eventually be right, in hindsight. So at that time also we did a piece, right? And our thing always is to try and nudge the user, right? Like if you are in the markets and something there is an outcome which is not positive for you, then how do you deal with it, right? So when people used to sell or stop a SIP, we would give them a small piece of nugget, right? Like if you're stopping the SIP or if you're selling just because of the market volatility, then read this piece, right? And this piece had nothing to do about market levels and valuation. It was purely like about behavior, right? So there's a great Mike Tyson quote, which is actually one of the best things that he has ever said. It's like everyone's got a plan till they get punched in the face.
That is spot on.
And investing is like that. Right, so everyone starts a SIP thinking I'll never stop it. Trust me, and I mean, we can do a field study. We talk to a lot of our investors. No one thinks about I just want to do it for 3 months or I just want to do it for 2 years, right? Then the behavioral part of investing that's the journey. What happens when markets actually fall 20%, right? So there's a lot of data on that, and the most famous anecdote which we have also written about is actually concerning Peter Lynch, storied investment manager, some 29% annualized returns over 13 years, right? Phenomenal, right? So he did this study to find out what was the actual returns that the investors got. That is the returns he generated.
So you're saying fund versus investor. That's like saying that if Gaurav has invested in a fund, he might or might not stick with it, might be selling, might be buying, whatever it is, and his return over a period of time versus what Peter Lynch himself gave the fund at a portfolio level over a period of time. That's the difference between investor return and fund return.
Precisely. Spot on, right? Like I couldn't have explained it better.
Sure.
Exactly, right? So what he found out was that the average investor in the Magellan fund, right, that's the storied Fidelity fund, got a 7% return, while the fund returned 29%.
Cool. Wow, that was a difference.
Yeah. So literally what happens is the manager has 3 gangbuster years. Money flows in after the returns have been realized. The manager has 2 bad years. The investors, they take those bad returns and then they exit. So a lot of investors actually have negative returns because they're chasing returns.
Yeah.
And that is called the behavioral gap. Now, this fund is we use this as an example because it is an outlier in terms of behavioral gap. Behavioral gap is not 22%. On average, what we know based on some of the studies that have been done in the US is that the average behavioral gap is around 1.5% a year.
Wow.
So investors, by trying to time when the fund will outperform or when the fund will underperform, they actually lose 1.5% per annum of the returns that the fund manager is delivering.
Wow.
Right. So a lot of these things are very fascinating, right? It tells us that, so many things that we think are true, that intuitively makes a lot of sense. In finance, it's just the data doesn't pan out like that.
So, I'm kind of visualizing this scenario. I put you in a chair and I just tie you up. That's it. And tell you don't do anything.
Yep.
Just continue SIP. Versus this guy who's on a chair, who's free to do whatever you want, and he keeps on fiddling.
Yep.
Market goes up, he buys more, market goes down, he sells, whatever it is. So you're saying the difference between those 2 guys is called the behavioral gap.
It is.
Because this guy is sitting with the fund doing nothing because he's tight. He literally can't do anything. This guy, and that can be as much as 1.5% per year.
Per year.
Yeah.
Right.
So listeners, here's a tip for you. Okay, check out the mutual fund that you have invested in, the SIP that you've got, and figure out, that what if you had just stuck to that SIP for 5 years, 10 years, or whatever is the average of your SIP, and what are the returns you got versus what that same mutual fund actually delivered for its investors if its investors had actually stuck throughout the entire tenure. One of the best examples that I can think of is, of course, HDFC Mutual Fund. And among the very, very first mutual funds they started, I think it was probably HDFC Equity Mutual Fund. It's hardly a few thousands of those original guys remain.
Of course.
But those guys have averaged, some 18 or 20% or whatever that number is over 20. My God, you just imagine 18-20% CAGR for 20-25 years, the kind of...
Doubling every 3 years, yeah. For 20 years, that's like 2 to the power 7.
Yeah. And
all you insane.
Had to do was do nothing.
Do nothing.
And just hold yourself to that. Okay. So, Gaurav, just before we go into a break, I just want to ask you just this one last question, because I spoke about mid and small caps. I just have to ask you about large caps.
Sure.
Anything happening there? Because, there has been this entire shift in large cap investing from actually investing in an actively managed large cap mutual fund versus going for an index fund or an index ETF. You have any thoughts, any observations on that?
Yeah, so we have fundamentally been an index first advisor. So the way we work, the way Kuvera works, is if you do our goal planning, we'll suggest a portfolio for you. But we also take a very libertarian, paternalistic view of it. If you want to buy something else, feel free to. We're not going to stop you. But if you follow our approach, then we have a allocation which has been index first. And so globally, actually, with the exception of no stock market that I can think of, it has been very hard for funds to consistently outperform their benchmark index. Now, in large cap, what has happened is that the benchmark index has become very investable in the past 3 to 4 years. So, theoretically, I can say, 2004, if you had invested in the index, you would have done better than a large cap fund. But how would you have invested in an index in 2004? With the exception of an ETF, you had the benchmark ETF then. I think you had it at 2004. I'm not 100% sure. But other than that, it was very hard. So in large caps, what has happened is now that the index itself has become a supremely easily investable, right? There are multiple index funds. There is a Next Nifty 50 index fund. There are equal weight index funds, which we again love a lot because equal funds do have an alpha over market weight funds in the long horizon. So what we are seeing now is that people are seeing the data, and there is a study called S&P Index versus Active that comes out every year that popularizes that just does a comparison of index funds versus active funds. And they are also regularly finding that in the large cap space, most funds find it hard to beat the index, right? So there is tons of evidence. People are seeing it. And what is also happening is that even investors who are return chasing, they look at the top 3 funds in the large cap space and the index shows up. Right. So we do see that shift in indexing happening. It's not as big or as profound as, some of the online kind of tracking on it would make you to believe, but it's a positive step forward. I think it will also make the alpha generators, right, the active portfolio fund managers, know that now we have an investable benchmark. So you better deliver on your promise to beat it.
As compared to doing some index hugging or something and just...
As compared to doing index hugging, more than that, large cap funds in India outperformed historically because of style creep. Yeah? You could have 50% small cap portfolio, still call yourself a large cap fund.
And deliver that alpha.
Yeah, and then call it an alpha. It was not actually alpha. It was wrong benchmarking.
Yeah. Okay.
Now that has become very hard because SEBI has very strictly defined rules. If you are a large cap fund, there is only that much style creep you can do. So these are all positive developments. I think. I think at some point the alpha generators have to be held accountable.
Sure.
And indexing will be the normal beneficiary of this.
Understood. And on that note, folks, we take a small break. On the other side of this break, we're going to be talking about the debt mutual funds. A lot of action happening out there. So stay tuned for that. Don't go anywhere.
Hello, everybody. Welcome to another awesome week on the IVM Podcast Network. If you are not following us on social media, please make sure you do. We're IVM Podcast on Twitter, Facebook, and Instagram. And also, just a reminder, if you like what you're listening to, take a screenshot of what you're listening to and tag us on social media, and we will repost your post. Also, please do tell a friend if you're enjoying a podcast which you think a friend would enjoy. Do tell them. I think that is something that really helps us. I think that we do see, increases in listenerships when you guys do that. So please do tell friends that you are enjoying what podcast you're listening to. Last week, we launched a new show called Agla Station Adulthood with best friends Ritasha Rathod and Ayushi Amin. They talk about their journey into adulthood. On the first episode, they discuss crushes and female friendships. And on this week's episode, they try to crack the code on how to adult. You can also catch Ritasha and Ayushi on This Week Cyrus Says, where they talk to Cyrus about the podcast, what constitutes acting like a grown-up, and Ritasha gives Cyrus detailed instructions to reach Mud Island. On The Scene and the Unseen, Amit Verma is in conversation with economist Mohit Satyanand about what constitutes the economic crisis. On What a Play, Akash and Siddhartha joined by fellow comedian Harmanpreet Singh. They talk about fast bowler Jofra Archer, the India-West Indies series, Ravi Shastri getting reappointed as coach, and a whole lot more. On the Edge and Sledges Cricket Podcast, Ashwin, DJ and Varun discuss the Gale Storm, Shreyas Iyer's beautiful knock, Virat Kohli striking a century, Steve Smith's injury, and a lot more. On The Origin of Things, Chuck narrates a short story about an old brand. It might just be the shortest podcast in IVM history. Check it out. On Marbles Lost and Found, Zen and Avanti are joined by podcast producer Janam Diwan for part 2 of dealing with grief and loss. On Mr. and Mrs. Binge Watch, Anirudh and Janice discuss Netflix originals Glow and Orange is the New Black, which are back with new seasons. On Keeping It Queer, Naveen and Farah talk about the differences and similarities between gay dating and straight dating. Their guest is Mansher Singh, a writer and web series creator. On our Kannada podcast, Thale Arate, Dr. Chandan Gowda joins Surya and Pawan for a conversation on the cultural politics of development in Mysore. This week on the Filter Coffee podcast, Karthik Nagarajan talks to the founder of Kriya, Praveen Shekhar, about professional speaking. And with that, let's get you on with your show.
Folks, welcome back to the behavioral aspect of investing special on Paisa Vaisa. My guest, Gaurav Rastogi, CEO and founder at Kuvera. Gaurav, so we spoke about the equity piece of the mutual fund story and the behavioral aspects of how people tend to get nervous during a market crash and how it's shaped out in mid cap and small cap versus whatever. So I want to talk about debt funds now. Go back maybe 4-5 years, again around about 2017, maybe to even 2016. Debt funds as a concept was largely institutional. Retailers, people like me, people like maybe some of the listeners on the show probably didn't know the various types of debt mutual fund products out there. How would you differentiate between an income fund versus a credit risk fund or a long-term fund? But maybe somewhere on demonetization, and this is completely anecdotal in my mind. Please, I would, it would be great if you can help us with the actual statistics on that. At some point of time, this entire tailwind for retailers to go into debt mutual funds as a very viable way of investing either your liquid money or even some amount of asset allocation over the long term.
As an alternate to FD.
Yeah.
That was the hook.
Yeah. As an alternative to FD.
Incorrect hook, but that was the hook.
Yeah, that's what. So why would you put your money in it? So that trend has happened. Okay. Yeah. Okay, so that was a historical thing, and today as we stand, every time I open the newspaper, there is something about some DHFL or something about some NBFC, something about credit rating going down, and the idea that a debt mutual fund can actually lose money or your NAV can actually go down in debt mutual funds is not something that is very common, and definitely not something that distributors would have told or advisors would have told their retail clients. So I want to know your take on this, and then we'll get on to the behavioral aspect of what you should be doing.
Sure. We think about this, and I personally think about this as a mis-selling story. I think selling them as an alternate to FD, you anchored the investor कि ये तो lossless product है.
Behavior again.
Because you anchored them to this being an alternate to FD with 1%, 2% more yield. The investor basically thinks they're zero loss product, right? Now, even if globally you look at investment grade bonds or high yield bonds, they have a default rate, 50 basis points to 1.5% or whatever it is. Investment grade bonds default, high yield bonds default, and when bonds default, then mutual funds who carry that bond will take a disproportionate hit, right? But that's just part of how bankruptcy works. So we cannot be a society that says failure should be celebrated because that's how we learn, and also be a society where NPAs are being brushed under the table, right?
Sure.
So eventually what has happened now, and this is all coming up to fore now, is because you have that bankruptcy law. So people can go in and corporates can go in and default actually. So the macro story, which is what most AMCs will tell you, is that the actual amount of default that is happening is a very small percentage of the total debt fund AUM, which is true. The human story though is that people who were caught in those funds, whether it was a DHFL fund or a BOI AXA fund, they are seeing losses which are scary, and that money is not coming back. Right. So both parts of the equation are actually true. It is a human story. It's a sad story. If you were trapped in that, it's tough luck. It's luck of the draw. You can call it anything. Hopefully, it was not a large allocation of your portfolio. But on a macro level, this will happen, and to some extent, this should happen.
It is the bankruptcy part. And this is, like you said, mutual funds investing in this, that's also part of life. You can't.
So what happens is, right, like a lot of people question this and like, okay, if they knew, why didn't they sell, right? Some of it, so I don't know if you can say it was malfeasance, maybe it was.
That's a separate
But a lot of
topic,
times what happens is, you're stuck with a bad asset. You can't sell it. Who will buy the bad asset, right? So once the market knows you're stuck with a bad asset, you can't sell it. So effectively what happens is your good asset gets sold. And here is some of that information gap starts playing. The corporates know and they have what we call an informational advantage. So if I can find out even a week before that something bad is going to happen with corporate A, I'll go and see all of my holdings and I'll sell all those mutual funds because I'll get the good bank part, right? The good debt part, which the mutual fund can sell. And everyone else by default is left with and disproportionately, this is true that retail is left with the basket. So that grievance is very well justified. And that information gap, how do you bridge it? Like, how do you make sure that the corporates and retail find out at the same time that trouble is brewing? I mean, I don't know if I have any answers for that, but that is the crux of the equation, right? So ideally what should happen is, like, if it's a mutual fund and say that the bad debt was 5% of the portfolio, everyone took a 5% hit, most people won't be that sad. What happens in reality is that the fund loses 90% of the assets, and that bad debt becomes 50% of the portfolio because the good asset flees. They don't want to take that 5% hit. And then the people who are left with the bag get a 50% hit. And there's no easy solution for that, but that information gap is definitely an issue.
Okay, so do you think the communication can change to benefit the behavioral aspect out here?
Some of it...
I'm talking about debt mutual funds only. Equity,
I know.
Pata hai ki there is risk, blah, blah, blah.
So first thing is that people should not invest in debt mutual funds as a substitute to FD. FD is riskless. This is not. There has to be a clear differentiation made. Some of the new rules that are coming up under SEBI, where even liquid funds have to do mark to market, which is a good thing. Volatility, seeing a price movement which is not a straight line, is the easiest way to get people to see risk. When that line dips down, risk. Line goes up, happiness, right? So as a substitute to FD, that has to be stopped because it's not. There has to be clear communication that these vehicles do carry some amount of risk. Defaults are very hard to predict, by the way. They're notoriously hard to predict. Obviously. There has been enough academic work. There's something called a Z-score. There's the Altman Z-score. There are lots of different frameworks are in place, but none has a very good rate of predicting which bond is going to default next. Right? So this part that, some fund manager would know, I don't think so. It's a valid expectation to have. I wouldn't count on it.
Okay, great. So that takes care of the equity mutual fund side. We spoke about SIP, we spoke about debt mutual funds. Gaurav, tell us about the ideal behavior out here on both the sides, equity, debt, even at a portfolio level, at an asset allocation level. What would be your message to our listeners on how to get your asset allocation right and timing these ups and downs in the market? Right?
So overarching rule in life, in investing, first thing is keep it simple. Adding complexity is not your friend, right? So that's the first part. So for example, look at your cash track. How much of your money is not invested versus getting 2% more on what is invested, right? Return chasing, not a good thing. Second is keep your portfolio clean, right? A lot of people have too many funds, again, because it is part of that return chasing, because of that endorphin, right? You see that 3-year return, 20%. Natural hota hai. You see a 3-year return of 20%, natural thing is, you will straight line it for the next 20 years, which is blatantly false. The next year it could fall 50% for all we know, right? So that has to stop. That return chasing happens in every asset class, and that is one of the behavioral gap in returns, right? The one that we talked about, fund manager return versus investor return, is purely because of return chasing. Return chasing is the biggest behavioral vice. Cash drag, I would say, is the second, which is where you focus very heavily on the small amount of your portfolio to get 1% more return in that portfolio while you have 40% in cash. Deploy that 40%, you will be a wealthier person, right? Third is to temper your expectations, right? I think people do straight line a lot. They do carried away with 15% return, 18% return. All of these thumb rule based investing advice has to stop. At best, what you can expect is inflation plus equity risk premium. So in India, 5% plus 6%. So in India right now, if you're thinking about long-term returns, inflation is roughly 4-5%. Equity risk premium will be around 5-6%. 9 to 11% is what your expectation should be.
That suddenly sounds very low, doesn't it? I mean,
it does, because
benchmark return over the last 15-20 years has been 15%. But I buy
what was the
you're
inflation
saying.
then?
Yeah, 8% maybe, and 5% is your
Right. When inflation is 10%, you should expect 16% returns. See, hota kya? the cost of living, the real cost of living is inflation adjusted. The cost of assets should also be inflation adjusted. No? You can't just say my asset should keep on growing at 20% while inflation is 1%.
Yeah.
We are going into an environment where most of Japanese debt is negative yielding.
As in they're paying you to...
No, you are paying
You're
the
paying that's what. So you are paying the government to keep your money safe.
Yes.
Yeah, that's what.
Europe, the same thing is happening, right? In such a deflationary global environment, to expect that India inflation is going to be 7-8%?
Not happening.
Not happening, right?
Yeah.
So you have to temper that expectation, and it is the role of an advisor to go out and say, no, yaar, ye 15% to milega hi.
Who said?
Why?
Yeah, why?
So the economic rationale has to be strong. Behaviorally, the other big thing that users should do is fill it, shut it, forget it. It was a great ad. It's a great message. For SIPs and all, just let it run. If you have a 10-year time horizon, right, just let it run. There are simple behavioral hacks you can do. One is don't take a decision till you discuss it with 2 or 3 people. Mostly when you take a decision at the spur of a moment, that's when you do that over trading. That's when you take to a decision because you're just so emotionally vested in it. ये आप कर देते हो.
CNBC पे flash आया red color का एकदम अरे something has gone wrong.
उसी में if you delay that decision by even a day, you will probably take a better decision, right? So make sure that you have thumb rules like that. Add in your calendar, add a rule today. When the market is at its high, at that point you should add a rule or add a reminder to yourself every month that on this day I promised myself when the market will fall 30%, I'll invest 10% more.
Interesting.
Because what happens is when the market actually falls 30%, you will not do it.
Yeah.
But because every month you're seeing that message. So the behavior hacks are actually very simple, and they're mostly about reaffirming your faith that dollar cost averaging does work. That when markets are low, it's a good time to invest. When markets are high, it's not the best time to invest. Having said that, timing market is equally hard. 2016, 2017, market is at top. 2018, market is at its top. 2019, again, market is at its top. But who knows, actually, to be very honest, right? So, boils down to these 4 things, right? Like continue your SIPs, don't stop your SIPs. On the margin, you can do some asset allocation, you can do some, kind of timing of the market, but overall it doesn't work. Return chasing doesn't work. Expectations have to be tempered, and you cannot sell risky assets as an alternate to FD.
Fantastic. I think that's a good summary of the discussion so far. Gaurav, wrapping up the episode, tell us about Kuvera. I know it's been there for quite a while. It's got a really nice website. I had a look at it. Just walk us through the entire process, right? From onboarding to what can our listeners expect on your platform.
So a lot of things we spoke about, right? So we follow these philosophies. So what we say is what we do, right? So we are a goal planning based website. So if you tell us what your investment goals are, we'll tell you how your portfolio should look.
Signing up isn't tough, is it? And
signing up isn't tough.
What you need the
and nothing documents? Actually, if you're KYC certified, we just need your PAN number and date of birth, and you're good to go. You can consolidate your existing portfolio on Kuvera.
Okay.
And then we'll do a goal planning on top of that and tell you how much more you need to achieve your goals. We have an index first portfolio recommendation. We do talk a lot about these behavioral aspects of investing that, don't chase returns, don't sell just because there is panic on the airwaves, because short-term prediction is hard, long-term prediction is equally hard. Prediction is hard. Yeah. Let's just say that. So, and we have built it from a very investor-first point of view, right? So we have, if you're an existing investor, like for example, an existing investor, you can import your portfolio into Kuvera. You can track it at one place. You can switch your regular plans to direct plans in a tax efficient way. You can do your entire goal planning. If you have multiple accounts, right? So in India, it's very common for the husband to have an account, to wife to have an account, and then they'll have 2 joint accounts. One is husband first, one is wife first.
Sure.
So you can track all those accounts under one login. We've just launched something called tax harvesting. There is a 1 lakh long-term capital gains exemption, right? So we help you harvest that tax.
Plan that,
yeah. Because it's in your favor. Even if you don't need the money, you should sell and buy mutual funds just to capture that 1 lakh of taxes. So our endeavor is always to build these tools, these features, this intelligence that can help investors do better. And that's how we're going to continue.
Okay. Folks, that is a wrap on this episode of Paisa Vaisa. We spoke about the behavioral aspect of investing. My guest was Gaurav Rastogi, CEO and founder at Kuvera. Gaurav, thank you so much for doing this for us.
Thanks, Anupam, for having me here. Pleasure.
No material on this show should be considered as financial advice. The material on this show is for informational purposes only. Please consult a financial advisor before taking any investment decision.
Are you constantly seeking happiness? Wondering how to make the most of every day? How not to let your inhibitions stop you from achieving your goals? It's now time to get your A game on. It's time to unlock your true potential. Tune in to the Empowering series with me, Zarina Poonawalla, to feel empowered in all genres of life. From behavioral skills to management skills. From health to relationships. From mental well-being to emotional well-being. And of course, your finances. I've got you covered. With these tips and tricks from me, Zarina, and true life stories from my amazing guests, you're bound to bring your purest to the table. Tune in to the Empowering series with Zarina Poonawalla every Thursday on the IVM Podcast app, website, or wherever you listen to podcasts.
Filter coffee is a fascinating beverage. You need to pick the right beans, blend them in the right proportion, roast them to perfection, and slow brew at the right temperature to get the perfect cup. Which is exactly like great conversations as well. You need to track down the most interesting minds, get them into their zone, and settle down for an unhurried, unscripted chat. And coffee for me is always, always, always best enjoyed with friends. I'm Karthik Nagarajan, and do share my table as I meet some of the most interesting people I know and sit them down for a strong cup of coffee and an even stronger conversation. Join me every Wednesday for a freshly brewed episode. This is not frappe. This is the Filter Coffee Podcast.